everyone should move to dividend growth investing. What I like about dividend growth investing is that I can start buying cash flow now. My cash flow will keep increasing. Analyze dividend safety score and moat analysis. You are making the complete fundamental analysis. It's very simple to be a dividend growth investing. What it's difficult is to do it month over month. Look for consistency on what people say. I can control my dividend streams by controlling two parameters based on the dividend yield theory. You don't have to think about it ever, and it's gonna work because you are tracking the most efficient market on earth.
Investors, welcome back to another go-round of Masters of the Market. Now this week, I am incredibly excited to have Caio on with me, coming in from Italy. So Caio, I am happy to have you on Masters of the Market to talk all about dividend investing, your personal journey, how you got to where you are today, which is, of course, the first question. So I'm going to go ahead and pass that over to you. How exactly did you get to where you are today?
Okay, thank you very much for having me, Ari. I'm a big fan of your channel. Keep going, keep up with the consistency. You are growing, and I'm sure you're gonna grow a lot because you have a very fun channel. So thank you for pronouncing my name almost perfectly. My name is Caio. I'm a Brazilian. I've been living in Italy for 7 years with my Brazilian wife and our Brazilian dog also. We bought the dog from Brazil. So I started in the investing world more or less 5 years ago when my wife presented it to me. Initially, I started with some instruments that we have in Brazil that are very similar to bonds, government bonds. And then slowly I moved on to the stock market, and then I fell in love with the concept of dividends. Later on, I evolved into a dividend growth investing, and that's what I've been doing for the last 3 years, more or less. I'm a dividend growth investor.
So Kyle, let me ask you this. Why, whether it's dividend growth or just dividend investing, why dividend investing? Because we all know that you can go right into growth and really see a lot of growth very quickly, especially as a younger investor. What pulled you into dividend investing specifically?
Yeah, so I guess it's 3 points to answer you. The first one, at later stages of my life, I wouldn't want to change from growth to income like the majority of people do. What I like about dividend growth investing is that I can start buying cash flow now. My cash flow will keep increasing until the point I can live through it, but it will still keep increasing because the companies, even if I consume everything, companies will still be increasing their dividend payments. I like this concept of starting building my cash flow right now, not having to change strategy later on. Third point, I think dividend growth investing is the healthiest strategy out there. I mean, psychology speaking, because when you invest for growth, you buy a stock and then you hope for price appreciation. And then there's gonna be a lot of roller coasters in between. I think this would kill me with anxiety. With dividend growth investor, of course, I'm gonna be buying companies that I wanna see their price, I wanna see their share price go up over time. But if I'm focusing on my dividend stream, then I'm focusing on an indicator that can only go up. I mean, companies can cut their dividends and so on, but mainly my indicator would only go up. So I think that's the healthiest strategy out there.
Let me ask you this. Do you ever get anxiety about, like, we're watching the NVIDIAs of the world as of like the last few months, maybe 6 months, just skyrocket? Do you ever get that FOMO or anxiety on the other end? Because again, you could jump into growth, catch the wave of that, growth run, and then jump into dividend stocks. Or does that just not even bother you? Do you even look at those stocks?
I mean, now I am kind of immune to FOMO and those sensations that a lot of people get in the stock market. I've been studying so much dividend growth. I'm convinced myself so much that's what's best for our family. I don't get this anymore. But in the beginning, for sure, this happened a lot. I think that's normal. I think it happens to everyone. And then with time, you get and return on experience, you kind of get shielded against it. But of course, yeah, in the beginning it happened. I jumped to stocks that were growing a lot, and then I would get the obstacles. It would fall. I wouldn't know what to do because I just jumped in because it was increasing like exponentially. I think I'm immune to it right now.
I'm reading right now this book, this Snowball Warren Buffett book here. A fantastic read for anybody who's looking for a new weekly or monthly read here. What's interesting is I just read today that what kind of makes Warren Buffett is what you mentioned just now, which is immunity to the FOMO. And I think becoming immune to that is key, especially for dividend investors. So I want to ask you, how exactly do you develop immunity, and how can we train ourselves to just become a little bit more patient and not jump the
Yeah.
gun on, these immediate, bursts, I'm going to say, of hits of dopamine to jump in on growth?
Yeah. So judging by the book you are reading, I can tell how much passionate you are about investing and the stock market, just like myself. I loved that you mentioned this book because this one is one that I have not read, so I'm already taking notes here. So especially for people like us that we are all the time searching for it and researching and going after a new tool, a new strategy, FOMO can really hit hard. So what I do is I focused my time on reading those types of books, learning about new strategies. Because when I learn about a new strategy, is usually I find out that I like even more dividend growth investing because you start to find all the problems that the other strategies have, and then you shield yourself even more within your strategy. So for sure, studying is something that helps us create this shield against FOMO, because when you know what you own, when you know what is happening, why things are happening, it's easy to not jump in and take hasty decisions. So I guess the word is study.
Do you recommend people study first before they jump into the market? Because sometimes, or a lot of the times, what I've personally found was that experience comes in hefty handy. And a lot of us who jump on Masters of the Market, as I'm sure you know, you're once a viewer here, now on as a guest, but like a lot of us say, like, oh, we just jumped in. So for the everyday average Joe investor or beginner investor out there, where do you start?
Okay. So my first number one recommendation is to put, if not everything into VOO or something that tracks the S&P 500, almost everything into VOO and maybe something into SCHD that tracks dividend growth companies. And then in parallel, start to study, find what you like, find what's best for you. For sure, dividend growth investing is not going to be the strategy for everyone. There are going to be people that are going to find themselves better with index investing, people that can resist the anxiety and go for growth investing. So my suggestion is start with index investing. It's very difficult to get it wrong. And then in parallel, start to study, start to invest small lumps of money on what you are testing, a new strategy and so on. Find what you like, what you can handle, and then you can slowly switch to what you like.
Kyle, is there a point at which you would recommend that switch happens? Like, is it maybe your first 10K? Maybe it's less than that, maybe your first 5K. Like personally, I built an investment foundation, and that gave me a lot of comfort to then do exactly what you're sharing, which is have that base, the VOOs or SCHDs as your base layer, and then build on that. How do you know when it's time to actually start to put some of those individual stock building blocks on top of the foundation?
Ooh, that's a difficult question because I guess you only know for real when you have started putting your foot on something different. To know before, how could someone know before? I guess again, lots of studies, lots of YouTube videos, lots of books, conversation with different people that has different point of views, acknowledging what are the negative points of your strategy. Maybe that's a big step when you know what's the negative points behind your strategy, and then you recognize them and you accept them, and then you move into the strategy. I think that's the turning point, because then everything that happens, you know why they are happening. You know if it's a bear market or if it's something wrong with the companies you are investing in. So I don't think there's a amount of money, a threshold when people can start testing different strategies. I think it's about feeling, and if you're feeling more secure and acknowledging all the positive and negative points, I guess then you can start slowly putting your money on different things. I would never recommend lump sum investing to to new people because you never know. It's a new area for you. But I guess if you have all your money or most of your money in VOO or something that tracks the S&P 500, then slowly, monthly invest in what you believe in, I think that's the way to go.
I like the cautionary approach. Don't just throw everything into one basket and hope it works. Take your time, study up on what you need to, get comfortable with it, and then start to actually get invested into it slowly. Before we dive into your portfolio, I want to ask you, how exactly do you even come to find dividend stocks, like individual stocks, to add on top of that foundation?
So my process is I trust a couple of financial services that I like a lot. Simply Safe Dividends and Morningstar. So my process is I play around with the screener from Simply Safe Dividends. And what I like about those two financial services is that they will do the fundamental analysis for me. So Simply Safe Dividends will give a dividend safety score for companies. And basically what that score is saying is how sure it is that a company will increase its dividend on the next business cycle. And behind this score, there's a lot of fundamental analysis. They're gonna evaluate the financial position of that company, their moat. And for moat, I prefer Morningstar. They are experts on that. The moat analysis from Morningstar, so the competitive advantages of a company, plus the dividend safety score from Simply Safe Dividends, for me, it englobes everything that I need to know about a company. So I know it has competitive advantages. I know it is probably going to increase its dividend in the next business cycle. And then I'll play with screeners on dividend on Simply Safe Dividends. So I'm gonna, first of all, what I want is to have at least 9% of dividend growth by the companies, because I believe I can control my dividend streams by controlling two parameters: the dividend growth rate of my portfolio, and this is controlling by select companies that has higher dividend growth rate, and the starting dividend yield, and here becomes my valuation methodology for the dividend growth companies. But before, let me go back a little bit. So I'll do this screener. I'm gonna look for companies with wide moats, so high competitive advantages over their competitors. Companies with high dividend scores, so I know that very much probably they're gonna be increasing their dividends next year. I want 9% more of dividend growth rate. And then I build my watch list. There's a whole universe of companies that enter in those three criteria. And then I build my watch list. And then on my watch list, I will be watching the dividend yield of those companies. And here comes my valuation that is based on the dividend yield theory. I want to acquire each company at their highest dividend yield levels in comparison to their historical levels. So for example, I'm going to invent here some numbers. Nike, and I'm not sure if that's the way you pronounce it, the footwear company, they are yielding more or less 2% now. And this is one of the highest levels of dividend yield for Nike. And that's why it is, I have it green on my watch list and I'm buying it. But if I have a company, for example, Microsoft, that is yielding 0 something percent, if I go and check the dividend yield curve of Microsoft over time and I check the last 10 years, I will see that that specific dividend yield that we have right now is one of the lowest. So I'm not gonna jump in. I'm only gonna jump in when I have one of the highest levels. So what I like about this strategy is two things. First of all, good dividend growth companies, when they are presenting their highest level of dividend yields, there's a high probability they're gonna start an upward movement. But that's what I care less. Let's say what I care more is that I'll be starting my position on a company that has a high dividend growth rate at the highest dividend yield for that company. So I'm not sure this strategy grants the highest returns, but I'm positive it grants the fastest dividend compound I can get. That's more or less my process.
So let's now go underneath the hood of your portfolio. How many positions are in there, and what are some of the top positions that you own?
Okay, so now I have 25 positions. My top position is SCHD. It makes for 12% of the portfolio. Then I'll have an 8% position on VOO. And then I'm gonna have the individual stocks. Today I hold more or less 23 individual stocks. I guess my highest position now is NEE, NextEra Energy, the utility. I love the company because they have already announced that at least through 2026 they're gonna be increasing their dividends at a 10% pace. And now they increased a lot, so the dividend yield reduced a lot, but October, September last year, when I built the most part of my position, they were presenting a very high dividend yield, above 3.5%, I believe. So imagine starting a position on a company that already presents over 3% of yield, and it is increasing the yield at 10% rate. For me, that's the best case scenario, and that's why this is my biggest individual position. And then I'll have lots of other dividend growth companies. I'm not sure if you... I'm not gonna remember all of them by memory, but that's more or less my biggest positions, let's say.
Can you give us a few more individual stocks that you have in there?
Okay, so I have Johnson & Johnson, I have Nike, I have Toronto Dominion Bank from Canada, I have Canada National Railway, CNI, I have Meditronic, I have... It's difficult to remember them all.
Now you're really on the hot seat with this one. I guess I'll jump in with a follow-up question for you because you have a lot of solid, standout, high-quality companies in your portfolio. And that's pretty evident to me, whether we name all 25 or just list the handful that you did. Is it important for an investor to actually know what these companies do? Because as you were explaining your process here, I was like, okay, Simply Safe Dividends, you go on there, you're doing your filtration system, and then you're really looking at yield and dividend growth. How important is it, or perhaps it's not important at all, to know what exactly the company does, like how they make their money? Is it important to look at their, the fundamentals there in terms of financials? Talk to us a little bit about that.
Okay, so usually my opinion here is a bit different. In my opinion, if you can afford financial services that do the harder job for you and give you a final score for dividend safety and moat analysis or wherever you like to track, in my opinion, it is not necessary to understand a company deeply. Now, of course, the more you understand it, the easier it is to hold it. So Hershey, for example, Hershey is a position that I haven't and I've been buying in the last months, only Hershey, because it has triggered my target price by the dividend yield theory. So if you know why Hershey is suffering, so what happens to cacao prices and so on, what Hershey sell, what is their processes, it's much easier to hold it. Because, I mean, if you trust completely your financial services or the service that you have, then it's totally fine. But then if you don't trust so much, if you do your due diligence, if you know the company, it's much easier to hold during tough times. And if you are part of a value investor like I am by the dividend yield theory, you're gonna have to buy companies that are being beaten down by the market. So if you don't know what you own, or if you don't have financial services that do this for you, it's gonna be a tough time to hold them.
What's the total value of your portfolio? Where do you sit today?
So I am sitting at 50K today. It's never enough. I mean, when it's gonna be double, it's not gonna be enough. We always want more. So, but that's my position today.
And when it comes to investing itself, I want to just ask you this: like, where did the love for investing start? Because a lot of people who are either just getting started, sometimes they get started too late in the game. Some of us are starting early on, which is great. Where does the love for investing come from you? Because I feel like it's actually the love and interest in investing that keeps us in the game. Absolutely. And doesn't tire us out.
Oh, that's difficult to answer. I think I fell in love with the concept of earning money just because I'm saving money. So I fell in love with this concept, and then when I discovered dividends and the monthly cash flow that I could build, I felt like I was buying cash flow, and I loved that concept. Then I discovered dividend growth companies. I mean, if I was going through a tough time in my life, I couldn't buy new shares. I would still receive more year over year because the companies would be increasing their dividends. So I fell in love with all those concepts, and now this is what motivates me to keep going.
Now, you said in the beginning that your wife kind of looped you in on this investing game. How closely do you two work together when it comes to investments, or does she sit way over there and you're over here and you're doing separate, investments with different strategies? What's
No,
that look like?
absolutely not. Absolutely not. We do it together. It started with her presenting me the whole world. I fell in love with all those concepts that I mentioned to you. I started to read a lot. I started to watch you and other channels a lot. And then I think I discovered the financial services that give us quite some help. And then she trusts my decision. Sometimes she challenges me on the companies that I'm choosing. Sometimes she finds companies that I was not looking into because maybe she likes a product, and then I go and study and go and study about the concept behind the product. So I guess we do it together. To have capital infusions from both pockets makes it grows much faster than if we're gonna be doing separately.
You know what they say: couples who invest together stay together. And it's the classic. No, it's really beautiful to see, and I think it's important, to actually discuss this topic, which I want to hone in on. Having a partner that understands what you're doing, like not just investing wise, but the financial freedom journey in and of itself. Because I think a lot of us, in the rat race of life, are trying to obtain, I don't know, the status image of wealth, going after maybe individuals who aren't helping us get to where we need to be or want to be. Talk to all of us a little bit about that. Like, how do you pick a partner that is actually on this journey with you? And I want to even go a little deeper. Do you guys ever get in scuffles about what to invest in or where to put money or how to do it?
I mean, so about having or finding a partner that it's in the same ship as you, I think this is everything. If she's not on the same ship, it's gonna be very difficult to to manage investing with the expenses from life. Um, so and for me that's very important. And I guess most fights will come out of it, will come from those different opinions. So if you don't have someone that's on the same ship, it's gonna be very very difficult. I guess sometimes we have arguments or discussions on where to invest. Um, so the other day she was telling me about CVS and how she loves the stores from CVS, how she buys there all the time when how she likes the store when we were there. And then I was explaining to her that the company is going through some difficult times. Dividends safety score is a little bit blurry. We are not so sure if they're gonna if they're gonna increase their dividends next year. But she was like, no, but they will because the products are so good. The stores are amazing. So, but it's nice because. Uh, she presented to me Target, for example. We didn't invest in Target, but she was telling me about Target the other day. They were going through some political stuff, let's say, that maybe made the share price suffer a little bit. We didn't build a position, but now I have Target on my watch list because of her. So I guess we complement each other quite a lot because she doesn't have the knowledge I do, but she comes because she doesn't have the knowledge that I do. She comes up with different ideas that maybe I wouldn't have. So I guess we complement each other quite well.
I'm gonna say, if those are the arguments, if you will, happening for you two, that's amazing. I wish for everybody, like, where do we invest? CVS or Target or what, what companies? I want to zoom out and talk a little bit about just investing in general for the masses of us out here. Caio, what do you think some of the most common investment mistakes continuously are made, and how do we prevent them?
Ooh, okay. So I guess the two most common mistakes is investing on something because someone told you to, or because you watched a video about it and you go there with zero information, you put your money there, the stock suffers a little bit, you get anxious, you jump out, then the stock shoots up, you jump in again, but then now it's expensive. I guess the most common mistake is investing on something you don't know or have zero knowledge about. Second mistake, and I have been there, is falling for yield traps. So right when I started, it was still dividend investing, not dividend growth investing. I discovered ZIM, the Chinese logistics company. It was presenting over 100% of dividend yield. And then I thought, oh my God, over 100%. If I just hold them for 1 year, what I receive in dividends is more than what I have put on them. And then, of course, I bought them. In the next business cycle, they completely cut dividends. They haven't paid dividends. The stock price fell a lot. I jumped out and I lost a lot of money with ZIM. So I guess those two are the most common mistakes probably. And I guess also jumping a lot from one investment to another all the time. People that jump all the time, there's a lot of inefficiencies, fees, spreads that you are paying, and these also will consume our returns. And that's probably also a very common strategy. So to me, the way to fix this is to either completely move to index investing. You're gonna reduce all your expenses, fees, spreads, your FOMO. You won't have to put time on this. You don't have to study. Just put your money on something that tracks the S&P 500, and then over time you're going to have at least 9% per year of returns. Second point is, if you want to do something different than that, then study a lot before you put your money on it.
You mentioned quite a few times already, there's a difference between dividend investing and dividend growth investing. Now, I happen to agree with you. There's a massive difference there, but I want to talk about it with you and ask you, what is your opinion on dividend growth investing, capital G, and just dividend investing? And what type of investor should go more towards dividend investing, and which type of investor should go more towards dividend growth investing?
So I'm going to start by saying that I think there shouldn't have a choice. Everyone should move to dividend growth investing. And for me, the reason is very simple. It is very difficult for a company to be a dividend growth company. In order to pay increasing dividends every year, you need to have increasing profits, if not every year, quite consistently. And not every company can increase their profits every year. So I think when people focus on dividend growth investing, they are already filtering out 99% of the bad companies. There are still companies that are dividend growth companies that I don't like, but still, if you narrow yourself to dividend growth investing, there's a high probability you're gonna be selecting good companies. They're gonna very much probably increase their dividends in the next business cycle. And this for me should be already reason enough not to go for dividend investing. Now, when it comes to dividend investing, I don't like the inconsistency. So maybe there has been a good year, profits were higher than expected, we're gonna earn a lot, and then on the next year, it's a tough year, it's a bear market, interest rates are high, companies start to bleed a little bit. They're maybe even gonna suspend completely their dividends or pay a much lower rate. So I don't like this inconsistency. I like the safety. I like the feeling of knowing that even if for some reason I cannot buy shares for some time, I'm gonna be receiving increasing cash flow over time because the companies are gonna be increasing their payments. So in my opinion, there shouldn't even be a choice. Everyone should move to dividend growth investing, and I think dividend investing is the reason why there's people who are against dividend growth investing. Because in the many discussions that I have been on why people don't like dividends and so on, they mention dividend investing companies. They don't mention dividend growth companies. Everyone should move to dividend growth investing.
Talk to us a little bit about like maybe these yield max ETFs, because as we're talking about yield, I mean, the heck with dividend stocks, right? We have these option-oriented ETFs we could throw a bunch of money into and make a hefty amount back. At least that's what's presented to us. Why not go with one of these yield max or options-oriented ETFs?
Yeah, so I think there's only a small group that I see any application for yield max or those types of ETFs, and those are people that have already retired. They need the cash flow to live off, and maybe they haven't built a good total balance on their investing account. Maybe they haven't compounded enough their dividend growth companies to have high yields. So what they'll need to do is move part, at least partially, to yield max ETFs and live through the payments they're gonna receive. Now, when you talk about young people like us, it's burning money. All the money that we're gonna be receiving from the high payments, they are gonna be consumed by the share price that keeps decreasing over time. So in the end, we don't compound what we receive, and we're gonna be burning our total balance. What I like about dividend growth investing is today I'm starting with 3% or maybe 2%, whatever it is, but maybe when I retire, those 2%, they're gonna be 10, 15, or maybe 20%. So no point in rushing. It's okay to start slow, start with a low dividend yield, but then with something that for sure it's going to grow over time.
Kyle, let's say you have a buddy or a friend who comes to you, they want to get started investing, and they hear all the gurus on Wall Street saying, just ditch everything else and go right with the S&P 500, don't even look at anything. Would you tell them that that's an okay direction to go into? Would you tell them to veer into dividend growth stocks? What is the S&P good for, in terms of all the gurus telling us just do that? Why would we deviate from that?
Yeah, that's a good question, because probably doing that would be the right option for a lot of people. I mean, index investing, the advantages of it is that you don't have to think about it. You just put your money on it, you activate drip, and then you maybe can even automate the capital infusions you do every month. You don't have to think about it ever, and it's gonna work because you are tracking the most efficient market on earth. In the long term, you're gonna have at least 9% yearly of returns. Now, when people they have more time and the interest, I'm gonna present to them dividend growth investing and the concept of building your cash flow year over year until you reach a point where you can retire, you can live through your cash flow, and still you're gonna receive increasing payments year over year. Because the point about index investing is that at some point in your life you're gonna have to think about it. Now you're just throwing your money on it, and that's perfect, but at some point either you're gonna have to sell those 4%, the 4% rule that people say, or either you're gonna have to transition into income investing and maybe go into a yield max ETF or something. Index investing should be the first step for everyone to feel how the stock market functions. Also because index investing, you don't experience a lot of price movements, because in the end you hold a basket of the S&P 500 companies. Because when you hold specific companies, stuff can go wrong. They're gonna have bad years. You're gonna see your money going down. So if you are not already used to that concept, it's difficult to handle when this kind of stuff happens. So I would drive people to an S&P 500 ETF, and then slowly, after they get used to how the stock market with the stock market dynamics, I would slowly try to transition them into dividend growth investing.
Now, you have 25 holdings within your portfolio, 2 ETFs, VOO and SCHD, and then from there, 23 individual stock positions. Some of us have less than that. Some of us have more than that. How'd you get to the magic number of 25? And when is it too much? Like, when does it become burdensome for an investor to actually have, I don't know, some of us have like 70, 80, 90 plus holdings in there.
Now, usually people don't like my answer here. In my opinion, if you can afford someone, a consultant or the financial services that I mentioned, that do all the fundamental analysis for you, then I don't think we should limit ourselves on a number of companies. If you are someone that you cannot afford this kind of service, then probably you have to have a total number where it's manageable for you. You can understand what's happening with all of them, and this, I guess, is going to be a very personal number. But if you can afford this kind of services, then I would never limit myself, because I have my watch list. Now on my watch list, I only have, I guess, 60 or 70 companies, but slowly I'm increasing my watch list. And I would hate to have something discounted on my watch list and not be able to start a position there because I have already reached my maximum amount of companies in my portfolio. So no, absolutely, I would never limit myself on the amount of companies.
Now, when it comes to investing for all of us out here, maybe we want to follow suit on Caio, your journey and what you've been building. But clearly, along your journey, there must have been some mistakes. So I want to put you on the hot seat and ask you about some of the red flags that you experienced on your journey and what we should look out for or stray away from.
Okay. So my first mistake was falling for yield traps, seeing juicy dividend yields, thinking that I'm gonna repay my investment very fastly. And then what happens is that that company just paid one special dividend that was very high. Its stock price fell a lot, and then you see a very high dividend yield. And dividend yield is a past, it's an indicator that shows the past of the company, not the future. So that was my first mistake, falling for yield max. My second mistake, which is not as important as this one, but still I consider it a mistake. I was not focusing so much on dividend growth. I was focusing more on dividend yield. So I was giving priority to yield over growth. And over time, if you make a very simple Excel sheet where you can compound your starting yield on basis of a dividend growth that you select, you will see that on the long term, what matters is dividend growth. But I guess it was part of the process to go through those mistakes and find what is the right balance for me. If people could skip those two first mistakes and start directly over there, they would save a couple of years of their investing life.
So say it sounds good to me. Save some years there, and definitely some pain. I think a lot of us investors that go down the dividend route experience actually those very pains of regrets when it comes to yield chasing. Now, as you put together your portfolio, and you mentioned it before, whether it's you're jumping onto Simply Safe, you're looking for those dividend stocks. You've mentioned some YouTubers, myself included in there. I want to ask you, how do you personally know who to trust? Because here's the reality. There's so many of us out there. There's a lot more channels nowadays that are even coming about talking about dividend stocks. How do you know which ones to actually follow to then grab the dividend stock ideas and then run it through your filtration system?
That's a very good question. And when you are in the beginning, it's very difficult. To me, when I started to build my own library, read my books, make my studies, that's when I started to filter more for quality on YouTube and found people with consistency and with arguments that don't change from time to time. Look for consistency on what people say, because maybe you're gonna see a YouTuber talking a lot about a company, and then he's gonna completely switch to a different company and talk about the competitor right away, or maybe then he's gonna talk about a different instrument. It gets confusing. So I would say look for consistency. But again, when you do your own due diligence, it becomes much easier to filter for quality on YouTube, because there are people that simply get concepts wrong on YouTube, and when you know what they're talking about, it's easy to spot who's just saying superficial things or who's getting wrong concepts. I guess that's the secret. Yeah, do your own due diligence.
I love that you mentioned the word consistency. I think that runs hand in hand with a trait of a dividend investor. What are some other traits that you think need to either be developed or need to be at one's core as a dividend investor to be successful?
Good question. So consistency, because It's very simple to be a dividend growth investor. What it's difficult is to do it month over month along a very long term. So consistency, patience, because it is slow. The process is very slow. You start with very low amount payments, and then slowly they will grow until a meaningful amount. And then I would say patience is also important, because if you have any valuation method and you believe on it, you have to be patient to wait for your favorite companies to trigger your target price, so you can acquire them at the highest dividend yield possible for that company. So I would say consistency and patience are the traits a dividend growth investor should have.
And if you don't have those traits, is it just to the S&P? I mean, where do we go? Because there's so many young investors, especially. I wish I could say, wave a wand maybe, and just everybody can be patient and everybody can have consistent behaviors. I mean, again, just to bring this book in here, The Snowball by Warren Buffett, he talks about those two traits. I mean, it's important for investors to understand that. I almost feel like we've lost our Warren Buffett ways if we've ever had them. But can we train patience? I mean, that's a big one for all investors. I think we need more patience in this game.
Yeah. So I think for sure it can be trained, because you learn how to deal with your companies when they are getting beaten down by the market. So with time, you know that it's temporary. Bear markets are temporary. There's always gonna be a longer bull run than a bear run. So I guess patience can be trained. I guess when you are starting, if you don't have those traits, you're gonna have to go for index investing, because you're gonna suffer less with index investing. If you don't have those traits, just automate your investing process and never check your account again if you are doing index investing. Maybe that's something that could work for people that don't have those traits.
I
And
love that.
then
There
yeah,
should be on these apps, maybe like Robinhood, never check this app.
yeah, I guess that's and again, I'm gonna repeat myself for the third or the fourth time. When you do your own due diligence, when you study, and then you know what's happening, automatically you become patient, because you know what's happening, you know what it takes for a turn. You know it's temporary. When you know what's happening, you already know it's temporary. So again, when you study and you know what you're doing, patience comes by consequence.
I like that. I agree. I like that a lot. Now, I want to switch gears a little bit here, because every now and then, I mean, the unfortunate reality is these dividend stocks sometimes can go awry on us and we may need to sell. Now, we never really like to talk about selling because everyone's always about buy, buy, buy. Now, I just created a video on this whole concept of like, how do you know when to sell? And I'd love to ask you, in your opinion, how does one know when to sell? What red flags come up? And if red flags are popping up, should we sell right away, or is there a bit of a waiting game? Like, what's the process here?
Yeah, so that's something that's very personal, yet it's fundamental to have an exit strategy, because exit strategy is a shield against ruin. When you have an exit strategy, there's no risk a stock can go to zero and you lose everything, because when you know when to jump out, this risk doesn't exist anymore. So my exit strategy is based on three things. Either if the dividend safety score gets blurry and the score gets really low, and therefore I'm not sure anymore that a company is going to increase their dividends in the next business cycle, that's probably going to be a sell trigger for me. Same thing for the moat. When the moat is not wide or even narrow anymore, when the moat is non-existent, that's probably gonna be a sell trigger for me. But those two, I may make exceptions for those two if we're talking about absurdly good companies like Microsoft, for example. And then there's a third trigger for me that's it's not negotiable. That is a dividend cut, or a how can I say this, a not dividend increase, dividend kept constant. For me, those are not negotiable. I want to see my dividends getting increasing every year. So if someone cut or suspended the growth, I'm gonna sell and I'm gonna put on something that it's discounted on my watch list, and I know that I'm gonna have at least 9% of increase in the next business cycle. So, and what I like about those my criteria is because when you analyze dividend safety score and moat analysis, you are making the complete fundamental analysis. So if those two starts to get really dark, you know that something's bad is going to happen with the company, and I have already jumped out way before it goes to zero and bankruptcy. I think everyone should have their exit strategy. There are people that put profit taking on their position or stop losses. I hate both because they would make me stop the compounding of my dividend yield, but they they function for some people. So it's important to have your criteria. May I ask what is yours?
Yeah, absolutely. We'll spin the tables a little bit here. I actually agree with you on the dividend cut. I think that's one of the most glaring red flags if you're a dividend investor. And even if you're not a dividend investor, but you just so happen to have invested in a stock that pays a dividend, because there's that route as well. If there's a dividend cut, it immediately means that there's something wrong here with the flows of revenue coming in, the increased flows of revenue. Huge red flag. The second reason to sell, which really I've been harping on lately, is aligning your investor profile. So if you are a younger investor, perhaps you're in your early 20s, or maybe you're on the latter end here and you're an older investor, do these stocks that you're investing into align with your investor profile, with your timeline, what your goals are? And if they do not, then it is a red flag that should go up on your end, not the company's end, to actually sell. So those are just two of my metrics that I'm constantly looking at. Okay, what is the revenue coming in? Are they going to be able to afford to pay the dividend out? And on the other end, I'm constantly, year in and year out, I'm evaluating myself. What's my goal? Is my goal the same? More than that, is my investment timeline the same? And more than that, is this strategy still aligned with what I'm doing? So two ways in which I'm looking at that. Go
Because I
back.
like this a lot.
Thank you. I want to go back because you actually said something just before, which I found super interesting, and you mentioned it before earlier on in the interview too, to kind of have your head in the game and know what's going on. Now, I cannot agree with that more as an investor here. And I want to ask you about macroeconomics, because I feel like we're always in the know about our companies, right? What we're investing into. But we often kind of just turn our head to macroeconomics, like, doesn't really matter. Now, I understand the logic of that, argument that it doesn't really matter at the end of the day. But I've actually found that using macroeconomics, not to time the market, but to look into certain sectors during certain periods of time for real opportunity. Again, Warren Buffett was doing it, Peter Lynch is doing it, but I find that the everyday average Joe doesn't really do that. And I'm curious to know on your end, like, do macroeconomics matter at all for you? Do you use it at all to kind of look in certain directions?
Okay. I don't use it at all. I follow it. I know what's going on. I know what's going to happen in the US in the next week. I know about the tensions and the political situation across the globe, but I don't use it to take an investment decision. Now, this is going to be a little bit maybe of a big statement, but I don't think the retail investor is capable of factoring in macroeconomics when it comes to investing. I think that the big money with all their Bloomberg terminals and amazing analysts, they have already factored in everything that's happening around the world. And I think it's very difficult for the retail investor to find an opportunity based on macro.
Interesting. I always like to say it's kind of like becoming the CEO of your own life. And the reason why I got so big into macros is because I asked myself, some of these big wig investors, I mean, when they're on Wall Street, wherever they are making these decisions, do they just shrug off all the macro events happening? And that, for me, that answer was like, no, they use them to the best that they can to kind of look around. So again, I always want to say, don't use macros to time the market. That's not at all what I'm saying. Use them, if you're going to use them, to look around. Guy, I want to ask you about your goals, in the year ahead here, 2025, because as you just shared, I mean, we got the elections now as of this recording just a few days away here. We may get policy shifts. I'm sure, the dynamics around the world may shift. Interest rates coming down, a lot of things happening. What does your 2025 strategy look like? Is it changing? Are you evolving as an investor? Talk to us a little bit about that.
Okay. So my 2025 goal is my 2025 goal. It was my 2023 goal, and it's a very simple number. I want to have 12% increase in the dividends that I received in the year in comparison to the other year, without taking into account new capital infusions into my portfolio. So I want my portfolio to give me a payment increase of 12% year over year. And that's how and this is the foundation of everything that I do. When I say that I look for companies that pay at least 9% of dividend growth, it is because I know that the remaining 3% I will get more or less by reinvesting the dividends. So that's my goal. I have not reached it in 2023. This because when I built my portfolio years ago, again, I was still focusing too much on dividend yield and not so much on dividend growth. And it's very difficult to make this turn if you are not selling everything, because when you go for a high dividend growth company, they're gonna pay you very, very low in the beginning. So it's not gonna be so meaningful to switch the profile of your portfolio. So that's my goal. Maybe when I reach it, I will increase it. I don't know. Maybe it's enough to keep it going like this. But that's my very simple goal, and it's the foundation of everything that I do.
Now, you're over in Italy, at least as right now. Let's say you had the opportunity to invite one investor over to Italy for a little, I don't know, beer and pizza and a piazza for a conversation and a chat about investing. What investor would you invite? Which investor would you invite? And what do you think some of the questions you would ask that investor would be?
Oh, that's a tough question. I think I would go with Buffett, just because of the huge experience he has. He has been in the market for maybe 80 years, at least more than 70 years already. And then I would ask all about the specifics of his strategy. What is his filtration criteria to build his watch list? What are the resources that he used to make his research and find a new company? What's his exit criteria? What is how does he calculate his target prices? I would go again into philosophy of investing, and I would ask for patience and how does he build patience. I would ask about tips on how to keep up with the consistency. Yeah, I would probably go with the Oracle of Omaha.
Can't go wrong with the Oracle.
Yeah,
Which
yeah.
again, you gotta if you're into the Oracle, you gotta read this book. Incredible, The Snowball, Warren Buffett. I got one last question for you, Caio, and I'm always excited to ask this question. I'm gonna give you $10,000 to invest into an individual dividend or non-paying dividend stock of your choice to buy and hold for as long as that may mean for you. Which stock would it be and why?
I mentioned it before in the podcast. I would go with Hershey because it is presenting a very high dividend yield in comparison to itself, its historical values. It's for sure above 2%, I guess even above 2.5%. And Hershey has been increasing its payments for 10-12% every year. I think it's a company that it's always going to be there. They have a wide moat, and their wide moat comes from marketing. I guess in the US. A lot of people can name a lot of brands from them. I think it's a company that has been increasing their dividends for a long time, and that's what I love also about dividend growth companies. When you have been increasing your dividend for a long time, you have no room but not to increase in the business cycle, or otherwise your stock price is gonna suffer a lot. So I like those pressure, this type of pressure that this type of company has on themselves. So yeah, I would go on them because it's my favorite company, my favorite discounted company on my watch list in this moment.
Fascinating, because as you shared that just 2 interviews ago now, it was Colby, the DGI crab. When I asked this question, he also said Hershey. So
Amazing.
investors, maybe it is about time that we take a look into Hershey and see what's going on over there. We just had 2 masters that joined us here on Masters of the Market mention it. Now, Kyle, I want to extend a thank you to you for jumping in the hot seat and joining me on Masters. Investors, until the next go round of Masters of the Market, we will see you all there.